Hey everyone, this week I'm going to focus on what's happening in office real estate, which in turn influences where people choose to live, shop, and engage in activities. And on a macro level, the sector continues to generate positive momentum. Nationally, office space demand was positive for a 9th consecutive quarter, sustaining the slow but steady reduction of vacancy rates. The national average vacancy rate edged 10 basis points lower over the quarter to 15.9%, and that's down from a peak of 17.2% set in the first half of 2024. But while the momentum has been positive, it's been uneven. Vacancy rates for older vintage, larger office properties, particularly in the urban core, remain elevated, ranging from roughly 17% to the mid-18% range. While smaller, newer vintage office buildings, often in the suburbs, have generally outperformed. Some older vintage, poorly located or operated buildings may be completely vacant, but at the same time, some top-tier office assets in gateway markets are completely filled and are generating strong rent growth. So the office market as a whole runs the gamut from one extreme to the other. And while traditional office-using job creation has been weak over the last few years, there's a durable space demand driver that's been building momentum. And that's an increased trend of employees returning to the office. Now, I'm not talking about a complete return to the office. This generally isn't 5 days a week, although that is also happening. Hybrid models are still very much the norm. But overall, office attendance is back to 76% of pre-pandemic levels, with midweek attendance pushing north of 90% in several metros. And that trend continues to advance. More companies are enforcing return to office mandates, but the trend is also supported by many younger employees who often prefer working at the office as they develop their careers and relationships. I anticipate that office attendance will continue to make steady gains, especially on Tuesdays through Thursdays. As a result, office space demand will continue to gain ground. 4 metros currently have vacancy rates below their pre-pandemic levels, including Miami, West Palm Beach, Las Vegas, and Riverside San Bernardino, while several markets like the Bay Area, Austin, Nashville, New York, and Boston have experienced outsized space demand over the last year. But it's not all good news. As I mentioned earlier, there are numerous large, older office towers in several markets that are still facing severe headwinds, and the office delinquency rate remains elevated, hovering near 12%. Many of these underperforming assets continue to trade on a price per pound basis, offering investors with the ability to repurpose or restore the assets unique low basis opportunities. And although many believe the office market still faces a very challenging path to recovery, some investors see opportunity. Transaction velocity over the last year through the second quarter has been durable, about on par with the pre-pandemic norm. Overall average cap rates have stabilized in the mid 7% range, up by about 100 basis points from the peak of the market in 2022. But that said, there is a broad spread of cap rates between the top performing best-in-class assets to the bottom tiers of the market. At the end of the day, the broad-based return to the office trend appears durable and positive. And that's a strong long-term tailwind for the sector that will ultimately drive opportunity. But as I mentioned previously, the office sector recovery remains uneven, with each market, each submarket, and each asset requiring careful scrutiny. And therein lies the opportunity. Many office investments offer tremendous value-add opportunity, but unlocking it requires strong hands-on sector experience. Over the longer term, there's a lot of potential for investors who keep their eyes on the horizon.